Okay, well, let's find out what you are adding, what you do like. Let's get into your pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so value manager. You do have a lot of precious metals, but you're diversified. And so you've brought us a basket of diversified, probably not household names, certainly not with your first pick. The first one is Carlisle Companies, not Carlisle Group, the private equity company. It's Carlisle Companies, ticker CSL on the New York Stock Exchange. Roofing.
Yeah, I mean, roofing, weather protection for buildings, siding, cladding. They're one of the dominant leaders in the United States. Interestingly enough, Berkshire Hathaway also controls a roofing company similar to Carlisle, which they bought 100%. But it's one of those businesses. When you think of all the flat roofs and the roofs across all the industrial businesses in the United States, it's just an annuity stream. They all have to be repaired, after a certain number of years. They're looking for, new technologies. It's still a highly fragmented business. So Carlisle is able to buy up smaller players so it can do, again, acquisitions, consolidate. It's a business that generates literally, 30% return on equity, returns on invested capital of in mid-20s. I mean, this is an incredibly profitable company. Buyback stock, dividends. Why do we, like it now? And we've owned it now for a number of months. We haven't owned it for a long period of time. Is because people were so negative about, construction industry and in the building industry, and interest rates had just gone up an awful lot across most of the markets. And so it was one of those ones that was just overlooked, and it had dropped in value, and no one cared, even though it was continued to grow, and it's amazingly profitable. So it's one of those boring companies that just continues to make money, more money year after year, and great returns on invested capital.
And I guess if you caught it in the last couple of months, that's a great time, because it was one of those, darned sideways traders for a while, but then it came out with earnings. And I in looking at the results, they're trying to shift the business to more profitable areas. So are you, as part of your bet also that they've caught an inflection?
Yes, yeah, no, they are altering the business, changing the business, flexing it to higher value added areas. Even with the reshoring in the United States, a lot of the most of the business in the United States, there should be more development. They're involved in some of the builds of the data centers and so forth. Now that's a small additional add to their business, but these are all helpful additions, and they have increasing a lot of money in R&D, so specialized technology. So if you're a smaller roofing business, you can't keep up with them. The new kind of materials that they're developing for roofing and siding, cladding is quite amazing as we've studied it. So again, they get that moat, and it's going to be difficult to displace them. It's really an oligopoly for some of these big businesses in that area. That's why Warren Buffett owns one of them. Yeah.
Your second pick is MercadoLibre, not a household name here, but is in Latin America, specifically areas like Brazil, kind of like an Amazon.
It is, yeah. I mean, they operate throughout South America, 18 countries. It's a number one brand in terms of presence down there on the internet. It's about 3 times the size of Amazon. Amazon is in South America, so the dominant presence in e-commerce. We like South America. We think over the next little while could do quite well. So it's almost a play on South America. Mm-hmm. We've seen more conservative governments being elected. Mining and extraction is going to be more important in some of these economies. And so that could be a benefit, especially, again, with the Trump government trying to establish a better sort of Western Hemisphere approach. And MercadoLibre, the other thing is only like 5-6% of the market really is doing e-commerce. So it's very embryonic. So there's a lot more growth. It's not like it is in North America. And they also have relationships with advertisers. They have over 100,000 advertisers on their system. They got like 22 million, customers and businesses that are involved. It's a really growing business. They also have Mercado Pagio, P-A-G-O, maybe I pronounce it wrong, P-A-G-G-O. But that's a finance company. So they're also providing financing for people that are doing the e-commerce. Over $250 billion now a year in finance that they're doing. So they're also a fintech company in throughout South America. So it's an interesting combination, very well run, very well respected. And that trades at a free cash flow yield of about 8%. So you're talking about maybe one quarter of the value of Amazon in terms of when you get to free cash flow. And you get
let
to
me
metrics.
push back on that because I'm just looking at the estimated multiples, and guess what? Amazon's cheaper. 26 times versus MercadoLibre, which is 48 times. This is the Bloomberg estimates, so you might have
we've been looking at the free cash flow.
The free cash. Okay, so that's interesting. And I think part of why MercadoLibre has recently underperformed is on concerns of competitive threats from Amazon, which is expanding in some of their key markets. That's not enough for you to kind of have your conviction shaken.
No, because we think that the Amazon can continue to grow, and MercadoLibre also will continue to grow quickly. And it's such an underpenetrated market; they can both do quite well. But Amazon has had trouble in other markets outside of North America. They are not unbeatable. They've had to backtrack in some of their markets over in Europe and so on. So I'm not so sure. Our view is that we'll see. I mean, we like Amazon. We've owned Amazon for many years in some of our portfolios. But we think you can compete against them. And in South America, the South Americans throughout the many different countries in South America might like more of a domestic player rather than going to a big Amazon. So and they are multiple sizes of what Amazon is, and they continue to invest back in their business too. So and at the prices that you're paying, again on a free cash flow multiple, we think it's relatively cheap.
Your third one is Sprott. It's such a beneficiary of the gold trade, of the precious metals trade, even the uranium trade, because they've got their uranium ETF. Their assets under management has exploded. And I think now when they report, it's going to be like 57 billion. That's what people think it will be up to.
Yeah, I think they topped 60, but we've had a bit of a pullback.
Yes, that's right. Yeah, so they'll be growing back to that level. Why Sprott now? And talk to me about, riding through these periods of volatility. Yeah,
I mean, we've owned Sprott a little bit for a number of years, the last 5-6 years. And so a couple of things. Sprott's interesting because it went public in 2008 at $1.5 billion market cap on less than $7 billion in assets. And I was back at AIC at the day, and we thought to myself, wow, Eric Sprott is really, really gouging the market here. But I mean, I say that in all due respect. I mean, if you're going to go public and you're going to sell your stock, you do it when it's at a high. Yeah. It was incredibly expensive. And so, but he raised $200 million and off they went. And that was at $10 a share. But of course, they did a 10-for-1 reverse stock split in 2020. So that puts them at $100. So now they're at 160. Okay, approximately 160. So they've really only got up 60%. Now they've paid some dividends along the way and so forth. So you have to just look at the stock price. But it's kind of interesting. Now they have almost 60 billion US in assets, and they're trading at about 3 billion US market cap. Our view, now, again, you have to be very careful because when they first went public, they had a lot of hedge funds and they had performance fees, and that would swing their assets, how much they could pay to shareholders, and the margins were much higher and things like that. Obviously, they got ETFs and index funds. Your margins are much lower. So you have to be very careful comparing AUM to AUM. But our view is that that's a great way to play the commodity super cycle. If you believe that there's going to be a commodity super cycle, one of the best ways to play it is through an asset manager who is the leader in all of these various commodities. So if you look across their assets, as you said, uranium, nickel, copper, silver, gold, I mean, they've got every commodity covered in terms of these ETFs. And so I think, again, being an investor in mutual fund companies going back, 30 years.
There's a lot of parallels.
There's a great way to leverage the whole commodity super cycle. Now, it's not, where it's trading now, I'd say it's fairly valued. But I think if you believe that the commodity prices are going to continue to go up, they are going to leverage that in a beautiful way. They're going to get tremendous operating leverage in their business. They also have a tremendous brand. they've become synonymous with investing in commodities.
I mean, they were creating these ETFs when nobody wanted them.
Yeah, yeah.
They were like, cool, you're doing a physical uranium trust. Like that was
they were committed because they believed in the commodity trade and what was going on in the bigger picture. And you got to give them the credit for that. I think the other thing I was going to say is that they are an attractive takeout candidate also. So that's another factor. I think I would be surprised if the company remains independent. I don't have any information on it, and I say this and they hear your show, they might get mad at me or something. But no, I think if you are a large asset manager and you wanted to pick up the best commodity name in the industry, and it's $3 billion US, and you would pay a premium to that, I think that's an attractive candidate for any large asset manager. The largest shareholder in the company right now, individual, is Rick Rule. He owns about 10% of it. And Rick's always in for a trade, so I don't think he would oppose that if he got a good valuation. And and their reputation, I mean, they're known again for minimizing derivatives, having the real physical, and I think that's really paid off over the long term. Peter Grosskopf did a great job over the years building that business, and then it's been handed now to Whitney. And I think they're in a very nice position. But again, that's not one that just goes straight up tomorrow. I think they've done well. They've caught up in the marketplace. But I think that they're a real play on asset appreciation in the commodity space right across the board.
Well, we've had Rick on the show, so we'll make sure the next time he comes on, we ask him about that. What's the right price? Rick, I'm sure he will actually have an answer. I want to get a
he hasn't sold anything.
I know, yeah. I want to get a handle on risks, because you said, there was a pullback. They had 60 billion in assets. Now they could have 57 billion, go back to that. Like, how sticky are the hands in a downturn? How much might that be tested in Sprott's results? Because it was so swift, the recent volatility that we saw.
Yeah, it's a good question. If you're buying asset management companies, you do have to be prepared for volatility. And there's no question. I mean, again, I go back over 30 years, and I was always amazed when we bought, Trimark stock, going back, and or CI and things like that before they got involved in all the RIAs and the business that they've been doing now, but they were just a pure asset manager. Even though the asset management company, think about it, they manage bond funds, money market funds, Canadian equity funds, US equity funds, global equity funds. Their cash flow is actually pretty consistent. And yet the stock prices would be incredibly volatile. McKinsey Financial, another one, was big back in the day. And so I think you have to be prepared for volatility. What would make Sprott even more volatile is because they have a lot of ETFs and money can come in and out very quickly. And so I think that's one that we just will watch. We do think this trade, though, has another 3-4 years behind it, if not more. And I think that they're well positioned. So it's one that you'd want to keep your eyes on. If the commodity trade started to disappear, and we didn't develop the super cycle and so forth, then I think you'd back off and take a little bit of money off the table. You want to watch that. I just think over the next number of years, it's one way to play the whole space because they've got exposure to all of it. And if you believe that fiat currency, for example, is going to lose more and more purchasing power, which I think it's virtually impossible that it doesn't because of the debt, then that's one way to try to protect yourself through a diversified exposure to a lot of commodities in a business with a tremendous operating leverage.
Jonathan, it's been an absolute pleasure. Thank you so much for joining us on the podcast.
Great. Thank you very much, Amber. I enjoyed it.